So how would you like to double your dividends on the stocks that you own? Imagine getting double the yield on your favorite stocks. Imagine creating dividend yield from a stock that doesn't actually pay dividends. So I'm going to show you how with several examples. This is real. You will definitely thank me later for this. So if you're a buy and hold investor, you want to buy stocks, keep them forever, collect the dividends, reinvest the dividends, and never sell your stock. Let's say one of those stocks is Apple. Apple pays about 2% dividend yield per year. So let's say you wanted to make more than that in dividends, but you don't want to sell Apple. You want to keep Apple forever. So for this to work, the first step is you have to own at least 100 shares of the stock or any multiple of 100. So if you own 100, 200, 300, 400, 500 shares, then this strategy works. So here's what you have to do. So let's say you own 100 shares of Apple. What you could do is write a covered call, which means selling a call option when you own 100 shares of the stock. And you could do that every 30 days. So let's say I want to go 30 days out. So this is the option chain on Questrade. So let's say I wanted to go to May 17, which is 27 days out, as you can see here. I could actually sell a call option. So I'm not buying it, I'm selling it. So I'm collecting the premium up front. Now, the risk with writing covered calls is when you sell a call option, you're choosing a strike price, and based on that strike price, come expiry date, if the market price of Apple is trading above the strike price, then your shares will get sold at the strike price that you chose. So if you're someone that wants to keep Apple forever, you don't want to sell the shares. But there's a way around that. So the stock right now is trading at 203. You're going to sell a call option that expires in 27 days, and you want to keep your shares. So you want to make sure that the market price does not go above the strike price that you choose. So the column here, delta, this is the probability that the market price in 27 days will trade above that strike price. So this 19.19 delta here basically means that there's a 19% chance that in 27 days, the market price of Apple will be above $215. So if you're comfortable with that 19% chance, you can go ahead and sell a call option at a 215 strike price and collect, for example, $2 for the next 27 days. So $2 divided by 203, assuming you bought it at $203. So 2 divided by 203, that's almost 1% in 1 month. So times 12 months, that's 11%. So if you're able to do this every month, you would generate an 11% yield per year just by selling call options every month and by holding the stock. But that's if you're comfortable at that 19% probability that the stock won't trade above 215 in 27 days. If you're not comfortable, you could choose a higher strike price just to be safe. But of course, if you choose a higher strike price, the premium that you can collect will be lower. But since your goal is to keep the shares forever and to collect whatever dividend yield you can get, then you're not going to mind. So as you can see, at a 5% chance, that's pretty decent. So at a 5% chance that the market price of Apple trades above $225 in 27 days, you would collect a premium of 67 cents. So that's a fair probability. The odds are on your side that you've got a 5% chance that the stock trades above 225. So you basically have a 95% chance of keeping your shares because there's a 95% chance that the stock will stay below 225 in 27 days. So if you're comfortable with that, you can go ahead and collect 67 cents per share for the next 27 days. So that's 67 cents. Assuming you bought the stock at 203, that's 1/3%. If you're able to do this every month, that's 3.9% or 4% per year. So Apple was normally paying a dividend of 2%. You could actually collect an extra 4% per year by applying this strategy. Assuming you bought the stock at $100, you'd be collecting 67 cents divided by your $100. You'd be collecting 2/3%, so times 12 months, that's 8% per year. So that's an 8% yield on cost. So once you sell that call option, you still own the shares. You don't have to buy back the call option. Usually if you sell something, you have to buy it back. But because you own 100 shares, you already own the stock. The stock covers you. That's why it's called writing covered calls. The shares cover you and allow you to sell the call option. But obviously the risk is if the stock is trading above the strike price, then your shares get called away. They get sold automatically at that strike price. But you can avoid that in two ways. First of all, by choosing a strike price that has a very small chance of being in the money, meaning a very small chance that the market price is trading above the strike price. And you could get that information by looking at the column delta. So basically 0.05 means there's a 5% chance that the stock trades above the strike price. So that's a very good probability. So if you do that consistently, you're going to end up doubling your dividend over time, if not more. And even if in the rare case the stock does end up going above your strike price come expiry date, you can avoid having your shares getting sold automatically by actually buying back the call option. But in that case, of course, you sold the call option at 67 cents. You might end up paying more to buy it back just to keep your shares. So although that could happen, but it's not going to happen more often than you end up keeping your shares because the stock is trading below the strike price. So probabilities are on your side. It could happen, but it's rare, especially if you choose the right probability. But even if it does, there's a way out of it. But by buying back the call option that you sold, you might buy it higher than what you sold it at. That's fine, not a big deal. Just add it back to your cost basis. So instead of saying that you bought the stock at $203, you actually bought it at 203 plus whatever premium you had to pay in this case. But in general, if you sell a call option and collect the premium every time without having to buy it back, because the call option expires worthless, and it expires worthless because the stock ends up below the strike price come expiry date, it'll compensate for that one time where you have to buy back the call option because in that rare occasion the stock ended up going past your strike price. So you're definitely going to have more winning months than losing months. But of course, if the stock is trading at 203 and you choose to sell a call option at 205, then you're definitely playing with fire, because then there's a good chance that the stock trades above 205 come 27 days. So it's all about choosing the right strike price if you want to keep your shares forever, but still collect an extra yield from your shares. And then after 27 days, regardless of where the stock is, let's say it's at 215, well then the next month you do the same thing. You look for a strike that has a 5% probability of being in the money. So next month it might be 240, and then you're going to sell the call option at 240 and collect that extra yield. And another way to avoid having the stock price go past the strike price is to avoid doing this strategy during earnings. So if you know earnings is coming out during those 30 days of the contract period, there's a good chance that there's going to be a lot of movement. So if there's a lot of movement, then there's a better chance that the stock surpasses your strike price. So maybe avoid doing this during earnings, the month where earnings is coming out. So there's 4 months in a year where earnings comes out. So you're going to basically have 8 months where you could do this strategy and collect that extra yield. So let's look at another example. So let's look at a Canadian stock, Canadian bank stock, Bank of Nova Scotia. So this is a stock that you want to keep forever, and you just want to collect the 4% dividends that it's paying every year. So let's say you have 100 shares of the stock, so $7,300 that's invested in the stock if you bought it at that price. So you want to collect that extra yield. So first I would see if there's earnings coming out soon. And you could see that on Google or on Yahoo Finance. You could just Google it. So if there's no earnings coming out, it's safe to sell that call option. So I'm going to go 1 month out at least. So 17 days, or May 17, sorry, so 27 days. I'm going to look at delta, and I'm going to choose the delta that gives me a good probability. So at a 76 strike price, I get 7% chance that the stock price will surpass the strike price in 27 days. So the stock is trading at 73, and according to this, there's a 7% chance that it surpasses 76 come expiry date. So let's look at the 76 strike price. We'd collect 18 cents. So 18 cents divided by 73, that's 1/4%. So times 12, that's about 3% per year. So in this case, you're already getting 4% from the stock, and you'd be able to get an extra 3% per year by doing this strategy. So you'd be getting a total of 7% yield by applying this strategy. Let's look at Enbridge. So this is an energy company in Canada, pretty big market cap. I think it pays around 6% dividend yield per year. So let's say you were to apply this strategy of selling call options against your shares. You've got at least 100 shares, so about $5,000. So you can see at a 52 strike price, the probability is 18%. you'd be able to collect 10 cents. This looks like it's going to be a weak one. So if we look at 10 cents divided by 49, that's 1/5% times 12. That's about 2.4%. So you can go collect an extra 2.4% by selling a call option that's far from your current market price, just to make sure that you end up keeping your shares at the end of the expiration period. So let's look at Tesla. If your strategy on Tesla is buy and hold forever, but obviously Tesla doesn't pay any dividends, but you want to collect something out of it. So you can go for May 17, 27 days out. Look at delta. We're going to have to increase the strikes. So let's look at a 5% delta. So a 5% delta would give us a 335 strike. So the stock is trading at 273 right now. If you choose to sell a call option at 335, which is very safe to say that in 27 days, I don't think Tesla is going to surpass 335. Well, then you can go ahead and sell a call option at 198. Let's see what that gives us. So 198 divided by, now let's assume you bought the stock at 273. So divided by 273. So that's 0.7% times 12 months. That's 8% per year. So you just created an 8% yield on a stock that doesn't pay dividends by applying this strategy. So I hope you can realize how powerful writing covered calls can be. You can use it to double your dividends if you play it safe by choosing obviously a strike price that's far from your current market price to make sure that you end up keeping your shares. And you could use the delta column here to help you choose the right strike price. So basically this here, 0.05, means that there's a 5% chance that the stock is trading above this strike price come expiration date. And in order to keep your shares, the price of the stock has to stay below the strike price for you to keep the shares. And in the rare occasion, in the rare case that the stock does end up trading above the strike price come expiry date and you want to keep your shares, you could just buy back the call premium. But for that to happen, in the case of Tesla, for example, it would have to go from 273 to 335. So it would have to move more than 60 points in 27 days for you to for you to be in that position where you have to buy back the call premium that you sold just to keep the shares. So even if it does happen once or twice a year, you're still going to be on top because most of the time you were selling the call option without having to buy back the call option and keeping your shares at the same time. So this is how you can double your dividend yield with almost any stock. Obviously this will work better with some stocks more than other. So if you have any questions, leave them in the comment section below. Like always, if you can open an account with Questrade to trade on the stock market, use my referral code in the description below the video to get up to $250 back. And I'm starting a WhatsApp group where I'll be sharing my trades live as I place them during the day. So if you're interested, it's going to be $10 a month. Link will be provided below. And it is tax season, so if you're looking for an accountant to do your taxes, don't hesitate to message me. Link will be provided below. Thanks for watching.